Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me today is Michael Becker, but he is out closing another transaction. So James Eng, our other underwriter, is sitting into the podcast. And thanks for joining us, James.
Good afternoon, Paul. Glad to be here.
So we have an old favorite of mine in the podcast and somebody that you've heard on the podcast probably in the first fifth or sixth or seventh episode of the podcast. Rupa Keskar is probably one of the best multifamily operators in the Dallas-Fort Worth area. I like some of the stuff that she has done. We've closed a number of transactions with Rupa, and we're going to find a little bit more about what she's doing these days. Last time we visited with her was probably about 2 years ago. So she had done some smaller stuff 2 years ago. Now she's on to some larger stuff. So just like anything, baby steps, now she's making big steps. So we're going to talk to her a little bit about her last two transactions that she's closed. And welcome to the podcast, Rupa.
Thank you, Paul. Thanks for having me.
No problem. And so I thought we'd kind of talk a little bit more about your background right from the start. Some people haven't heard the podcast. And give me a little bit of background on Rupa.
So I've been doing multifamily investing for almost 5 years now. Before that, I was in IT. I worked for a large company as a consulting practice director. And the last podcast was a little over 2 years ago. I was under contract for my second deal. I still hear from people that they heard my podcast recently, and mostly it's IT people.
That's great. Is everybody pretty much knows that there's a lot of IT people that come into the multifamily business because they are good at checklists. They're good at follow-up and making sure that things happen on a timely basis.
It works the same way, if then else.
That's good. And so I thought let's ask a couple of questions. And James, let's jump over to you.
Sure. So, a lot of the listeners are really trying to get into their first property. But in this podcast, we're really going to focus on after getting that first property, maybe it's 50 or 100 units, how do you really accelerate and get into larger properties? And so maybe start there and tell us why you decided to go from 50 to 100 units all the way up over 200, even 300 units on your last two.
Okay. Well, the short answer is because I can. When I did my first one, obviously no one was going to give me money to do a larger property in terms of investors raising money, in terms of the bank. Just hadn't done any real estate, not even a single family rental. Just my own home was the only real estate I'd done. And now with a couple of smaller properties behind me, I was able to go bigger, so I can. Now, the main reason for going to larger properties is, the amount of work that's required to put a deal together, to purchase a property, review the contract, put together a partnership. It's pretty much the same amount of work. So why not just go bigger and do a bigger deal with better income?
Everyone wants to go bigger, but then have you seen any drawbacks of taking on a 200 or 300 unit property in the last year that you've bought yours?
No, I actually can't think of any drawback. I see more positives in doing bigger properties. When you do larger properties, it's economies of scale. It's easier to manage. You are able to get better quality employees. Contractors are willing to travel to Waco, to Sherman for a $1.4 million rehab as opposed to a $100,000 rehab.
Okay. All right. So let's jump in. So you're based here in Dallas. How did you decide to go down to Waco on these last two?
And how far is Waco away from Dallas?
So it wasn't specifically that we were looking in Waco. We were making a lot of offers in the DFW market. As you know, I own a property in Sherman that was 45 minutes drive from where I live, and made offers pretty much everywhere. And we had gone out to Waco to look at property that was off market and potentially was available. We ended up not getting that property. They still haven't sold, so we might still in the near future. But a couple weeks later, a property came on the market, and the property management company that I had talked to previously managed 3 other properties in Waco. So it was my first call to find out what they thought of the Waco market, and they loved it. They already managed 3 properties there, so it was easy to get them to add ours. So.
What are some of the characteristics you like in Waco that maybe the demand side or supply side in terms of what you're looking for when you're looking to buy a property?
Well, Waco has recently been put on the map for a positive reason as opposed to what it was many years ago, right? And also with the Rancho Davidian, and then also with the Harley-Davidson shooting incident. So a lot of negativity. But recently with Fixer Upper being a national show, I don't know if you guys are familiar with it. You know.
I think everybody's
yeah, so
Fixer Upper.
I had actually not watched it until after purchasing a property in Waco, and you tell people that we have a property in Waco. Oh, you watch Fixer Upper. So there's actually a lot of growth in Waco. Employment is strong. It's right on the way between Dallas and Austin, right off of 35. So a lot of our vendors, for example, our furniture company, we were trying to figure out a place in Waco to buy furniture, but we ended up getting it here in Dallas because they go along the corridor. They're like, we're down to Austin 2-3 times a week. We can just stop in Waco. So a lot of our vendors are going to Austin to stop by Waco. It's just...
And how about Baylor University that's down there too?
That has impact on employment, of course. We don't have a lot of student housing at our properties, but employment is strong because of Baylor, and a lot of people are moving to Waco because of Fixer Upper.
And again, how far from your house to Waco, how long does it take you in the car to drive?
With no traffic, it's about 2.5 hours. It's drivable. We're not there as much anymore because we're using a third-party management company. So once a week or every other week, not a bad drive.
So let's just start right there. So the smaller properties that were here local in DFW, did you self-manage those or did you have a third party?
I did. One of the reasons I started small with a 32 unit was because I wanted to self-manage, and I was going to continue self-managing. That was going to be one of the criteria. But because the property is further away, 2.5 hours drive, not as easy to be there every day like I was in the other 2 properties, and having a third-party company who already knew the market well, it made sense for us to use them.
So on the Sherman, the 100 units, is that self-managed?
That is also self-managed,
okay.
Yes.
So how did a lot of real estate investors like control of their properties, full control. How do you work with the current management company on the Waco deals?
Yeah, I am totally a control freak, so...
No way. I find it hard to believe.
Yeah. Sometimes a lot of people expect when you use a management company, you don't have to do anything, or you don't keep an eye on it, and find something to blame. It's a partnership like anything else, working with a management company. The company that we're working with, Citygate, we've had a relationship with them before. In fact, Paul, you introduced me to Dawn Way, and she did the due diligence for us in Sherman, but I ended up not using her in Sherman because I wanted to self-manage, but kept the relationship going. And we have a really good relationship. There's a lot of transparency, and they're really open to letting us have access to the software, very open to feedback with certain things. Given my background in IT, I don't want to see spreadsheets. I don't want to see emails. Would like things to be set up in the software, and they're really open to implementing the solutions using the software.
So how does that typically look? Let's say you buy the property. I think you bought one property in February, another one here just in the last month.
Yes.
And both those properties have a significant amount of rehab or a decent amount of rehab going into both of those. So how was that process of managing the rehab from afar and then with a third party?
Yeah. So rehab is very interesting because when I did my first property, it was a stabilized property. I remember Paul being there for the inspection and saying, you're the architect of this property. The inspector's here to do what you want to do, but you tell them where you want to go. And that was my first property, and I probably, changed a few things, what was necessary. The latest property, not the very last one, second last, 327 units. Property looks great, very clean. Everybody who went there said, property looks great. I wasted my time. I didn't even have to come here. It all looks great. My husband, who's not very involved in the business, drove there after we closed on the way to San Antonio. He typically doesn't look at our properties, drives there and goes, hey, I'm driving by this property. It looks really good. I don't know what you're going to do with that $1.4 million rehab budget that you have because it looks great. So it's like, well, you do what you do. You drive to San Antonio, you're a consultant, and I'll do what I do. So because it's a $1.4 million rehab budget, it was a lot easier. We were able to get pretty much all of our contractors from up here to go to Waco. So we managed the construction ourselves. We didn't use the property management company for the rehab aspect of it just because we like doing it.
All right, let's take a little turn out here. Your husband is Nitin, and Nitin is one of the nicest guys, smartest guys that I have ever met. Went to one of the best schools in the country, works for one of the largest companies in the United States. But what type of a role does he have in this multifamily business? Does he have a large role, small role, no role? Where does he come in?
He's played a smaller and smaller role as I've grown. Initially, he went for the mentoring class that I went to. There's a 2-day class with a mentoring group here in Dallas, a networking mentoring group. So he went for a class just to get an idea of what I was going to be doing and where our money was going. But apart from that, initially, Nathan's a good writer, so he helped me with writing some of the upfront documents, but he doesn't do that anymore.
No. I think the takeaway is that you run the show. Nitin is...
He collects the checks. His name is on the check, so he does sign on the check. And typically I give him the back of the checks to sign, and he turns it around and looks at the numbers.
Yeah, but keeping with my theme for this year of equal opportunity, women in multifamily real estate, I think this is a position that a lot of people probably fail to get into, that if they're females, about getting into value-added multifamily. And I've been banging the table to try to get more women into this business, because doesn't make a difference what sex you are. It really depends on how hard you work. And if you have a lot of smart people out there, that I want to see more women in the multifamily business. What's your take on that? Is it equal opportunity?
Yeah, it's just like IT. For some reason, there's not as many women who are in the lead role, but being where I am, I haven't seen any disadvantages of, people not wanting to work with me as an investor or contractors. You have one or two who don't want to answer my questions properly, and I just don't do business with them.
But with investors, success breeds additional success. And so you don't have any problems raising money at all.
No, our last deal, I think it was 3 hours that we raised $3.4 million.
Yeah, that's pretty good.
So what are those investors looking for? In today's competitive market, what are limited partners expecting in terms of return? And maybe talk about the last acquisition you guys did and sort of your pro forma returns.
Yeah. So we typically underwrite very conservatively, and we shoot for double-digit returns after 24 months and high teens in terms of IRR over a 5-year holding period. But having said that, on the last 2 deals, I don't distribute all of the income that we make, so distribution, I'm conservative there too. We have a pretty good cash balance, and we would still return about 9% in the last 18 months that we've owned the property, and we're looking to refinance pretty soon and get 80 to 90 at least out.
80 to 90%
of what
of
we
your
put
original
in.
investment.
Yep.
Right.
Yep.
Instead of going to the last deal, let's go to the second to last deal on the property down in Waco. So tell me a little bit about the name of that property.
It was called Sanger Oaks when we purchased it, and we rebranded it to Avila. Just wanted a clean name.
Was there any negative connotation with Sanger Oaks?
Yeah, there was a little bit of a bad rep for Sanger Oaks, and we needed new signage anyway. It was dated. It was, there was a sign that says Anger Oaks, which was probably true.
Probably. How many units was it?
327.
So 327 doors. How long did the seller own the property? Do you remember?
I want to say about 4 years. They bought it out of REO.
REO. Mm-hmm. So, James, what does that mean?
Real estate owned. So typically when a bank forecloses on a property, they will hold it on their books for a short period of time, but really banks are not in the business of running real estate. So as soon as they could sell it, the previous seller bought it and then, probably did a little bit of work on the exteriors, but really left the interiors for you guys.
Yeah. So they did do some on the exterior, but it was more clean up. There was no peeling paint or rotten wood or anything like that. It was, like I said earlier, a really clean property. And they had some level of rehab done. It was just not taken all the way. It was just very plain. It was very tired.
Yeah, and this was a stabilized property, evaluated property, a little bit of both?
I guess we call it a hybrid. It was already 90% occupied when we took over.
Okay.
Collections was a little bit of an issue, not too bad, but it was a hybrid. We were cash flowing from day one. We made a distribution 4 months after closing.
And so when you guys bought the property, did you try to retain any of the current employees on the property?
We did. So the property manager that was there at the time decided to stay with the management company that she was with, not with our new one. She decided that she was going to do something else. So we took the assistant manager and promoted her. Ended up not being a very good fit, but the property manager came back. She'd heard about what we were doing at the property, very excited with all the changes that were going on, and decided to come back.
And how much money have you guys spent on that property, just on the rehab piece?
The total rehab is $1.4 million. That's actually the loan rehab. Then we have a little bit that's outside of the loan.
So you structured the transaction, you did the acquisition plus the rehab dollars into the deal.
Yes.
And you did it at 80% leverage?
Yes.
Okay. But it actually needed more money
yes.
in the rehab. But the most that we could have given you was the $1.4 million.
We might have been able to get more than 1.4. We might have, but we didn't try because it's always nice to have rehab dollars that are not in the loan because it gives you a lot more flexibility to do little things that you hadn't planned for. You want to change direction. You want to spend a little bit more on certain things. So that was one of the things that I learned on my two other deals.
So why is that, James?
So a lot of times the lender is going to have not only a escrow, so you're going to put up 20, 25% of the money, but then in order to get the money back from the lender, there's going to be, an inspector that might have to come out, or there might be a fee to draw upon the money. So that might only happen once a quarter. And so if you have a lot of smaller projects that you want to take on, then having just the working capital to do it and raising that money up front helps you in that process.
So you got a Fannie Mae loan on that property?
Yes.
And so what happened to occupancy right after you guys bought the property? And there's a new sheriff in town, and her name's Rupa.
It went down.
Is that typical?
Yeah, it went down my first property too. It was 32 units, so every one that moved out was a big ding. And the first property, I hadn't expected that. It was because it was my first one. I didn't really know what I was doing. So it went all the way down to 66%. And it was my first time investing somebody else's money. I had a lot of sleepless nights. But starting with the second one, we expected that. Just as soon as you start making changes, they kind of expect that you are first going to collect rent. Property starts to look nice. They expect that you're going to raise rents. And because it's a nicer and nicer property to live in, we can be selective in terms of whom we want living there. If you don't pay rent, we certainly don't.
So with the first 6 months, how far did the occupancy go in this one in Sanger Oaks?
We went down to 84 from 90. So.
Okay. And so today collections are at what in terms of occupancy?
So collections are better. We're still not where we'd like to be. Physical occupancy is 92.5%, and it's come down a little bit. There's batches of people that we have to evict so it goes up, down. But economic occupancy, I would say, is about 91.5.
All right, James, let's do what is physical occupancy and what is economic occupancy?
Sure. Physical occupancy is really bodies in units. So if you have 100 units and 95 are occupied, it'd be 95% physical. But out of those 95, let's say 5 aren't paying. So on top of physical, we also look at what your actual collections are. So that might include concessions or even bad debt. So if those 5 aren't paying, then you're really at 90% economic.
So what you find in properties like this, where you bring a new buyer into the property that has a new management team, you do see occupancy fall quite a bit, just because different ways of managing properties, different way of collecting. Maybe they have had side agreements with the previous management company, but we're not willing to put that in those side agreements together. We're about to invest, $1.4, $1.5, $1.6 million. So we're going to change the look of the property itself. So be prepared to see occupancy dips and change of tenant base. So what you took on back 6 months ago or a year ago is going to look completely different than what it is, say, today. Would you agree with that?
Totally. In terms of you can tell just the way people come in wearing ties as opposed to.
Yeah. So you've seen a change of the tenants coming into the property itself. So. Yeah. Some of them maybe have been wearing plastic bags, and now you've kind of changed the look and the feel of the property itself. Let's talk a little bit about the change of the look of the property on Sanger Oaks. What did you guys do for amenities? And kind of describe, again, what's the age of the property and what's kind of is a flat roof, individually metered? What's going on with that property?
Yeah. So that property has pitched roofs, built in 2 phases, 78 and 79. So we went in and completely redid the color scheme because, like I said, carpentry, everything was in good condition. Roof was in fairly good condition, so just a little bit of roof repair. But we redid the color scheme very wild for Waco.
Really?
So after we closed for a while there, they were using Wake Up Waco as the slogan there. And we changed all the signage, very modern. We have signage that comes up at night. So
what does that mean?
It's a lit sign.
Oh, cool.
Yeah, it's not the spotlight, but the whole signage is lit. And we just finished the rehab on the leasing office, which had little compartment like maze. You have to go around the hallway to get to the manager's office. You can look through a little window to the assistant manager's office, and the colors were purple, blue, yellow, all over the place. And we just finished. We took down walls so that as soon as you walk in, you see the leasing agents, because one of the things that we observed when we were there before, because we're at the property quite a bit, we're overseeing the rehab. People walk in and they kind of look around because there was 3 doors. Do I go door number 1, 2, or 3, and who's where? But now they walk in, they see the leasing desk right there, and managers behind closed doors, and it's just very calming when you walk into the office. It's very quiet.
Did you guys have a tennis court on the property?
We did.
What'd you guys do with that?
So the tennis court that was there was just that, and they had 2 picnic tables just slapped on there and 2 arbors. So we turned that into an amenity center. It's called The Square, and we have barbecues. And
now, did you have to crush the tennis court?
No, we decided not to. It was going to be super expensive.
Yep.
So we decided to leave it. We're still haven't quite decided what to do with the surfacing of it, but we added planters all around, just kind of give it some privacy when people are having functions. There's games that are installed in there into a tennis court. So now it's more of a cozy, not a big box with, nothing.
So after all, 1.2, 1.3 million invested into the property and rehab, where do you think rents are pre-acquisition to now? on that property?
So on that property, rents were lower than the property across the street, which is the one that we went to look at initially. And they didn't have higher prices for upgrades or anything like that. Now we have an upgrade package that rents for $125 more for the one bedroom than what it did before.
Okay. And then on these larger properties, I mean, you took Fannie Mae loans. What's, once you've done the rehab in the first year, really turn over the tenant base, what's the exit strategy? Is it, to sell or take a supplemental? What are you guys thinking in terms of exit?
Yeah, for now, the plan is, and when we went in, the plan is to refinance, basically add a supplemental.
Okay.
Okay. Supplemental is pulling cash out of the property and returning the equity back to the investors, right?
Yes.
Okay.
So as a deal sponsor, you've been at it for a couple of years now. What are you seeing as sort of the most challenging aspect of being a deal sponsor right now?
The biggest challenge, of course, is finding deals. Everything seems overpriced right now. It's part of the reason why we had to go a little bit out of the DFW area. It's just finding deals that make sense.
So how are you overcoming that challenge, you think, in the next 6 months? Is there anything that you're doing to, whether it's meeting more listing brokers or going further outside of DFW? What is your focus on in terms of what are you doing sort of day to day in terms of finding deals?
Yeah, both. Paul really helps a lot with putting a lot of events together where we have an opportunity to network with brokers. In fact, I know for sure the first 2 deals that I did, we got because of Paul. Paul was there.
Oh, come on.
No, Paul was there for the tour on the first one with an unknown broker. They didn't know each other, but the selling broker liked the fact that I had money bags with me. So that really helped. I think they got 8 offers. Ours certainly wasn't the highest, but they took ours because of certainty of closing. The second deal was a broker that Paul recommended, and there were 2 very close offers in terms of dollars, and we got it again for certainty of closing.
So really building your team is a big aspect of it, because if you're able to present an offer with not only the financing lined up and then a track record of ability to raise equity, then that's really what the listing brokers are looking for, right?
Yeah, exactly.
They want certainty of execution.
Yeah, and on, like you said, going outside of, just a little bit further, and now that we have 535 units in Waco, if we were to do another unit, there, for example, the last one that we did, the 208 units, they had the property under contract with somebody else who, for some reason or the other, ended up backing out. We had made an offer before, which they didn't accept because they had a higher offer, but then they came back to us because they knew we were interested in the market. We knew the market. We knew what we were doing. We were not going to back out. They were doing a complicated 1031 exchange deal, so certainty of closing was a big deal for them. So it took, according to them, a slightly lower amount.
Let's kind of talk about your last deal that you closed. How long ago did you close that loan?
We closed on that on September 29th.
Okay, so September 29th, I'm writing this down. What's the name of that property?
Baxter Crossing.
Baxter Crossing. And how many units was that one?
208.
And what year was that property built?
84, 85.
And what kind of condition was the asset in?
That was also in very good condition. In some ways, better than Sanger Oaks, and others, not so much. Roofing did need to be replaced. Roofing is one of those things. You ask 10 people, you get 10 different answers. But we do have a trusted roofer, and also it's an issue for insurance. So some insurance company will not insure the roof if it's more than 15 years old.
And why was the seller selling?
They didn't have a lot of properties in the Waco market. This was an outlier, so they wanted to sell this particular property.
Do you know how long they owned it?
I think that not too long, probably, I want to say 2 years,
Okay,
if I'm not mistaken.
That's not too long.
No.
What are some of the things that you guys are going to do to the property to improve it?
So roof replacement is already done.
Oh, no kidding.
Yeah. So
You guys just bought this thing September 29th, and now the roof has already been redone?
Yep, inspected it yesterday. Roof's done. Again, we have our roofer, a trusted roofer, didn't have to shop around very much in terms of what we should do to the roofs. What there wasn't that much choices this time because it's pitch roof. You do 3-tab or composition, easy decision. And so roof's all done. And right now they're working on carpentry repairs, a lot of cedar siding still. They replaced some of it, but there's still a lot of that old, not in bad condition, but it just kind of looks dated because you can see the texture of cedar underneath the paint.
Are you pulling it off, or are you keeping it as is and painting it? Or are you
pulling it off. All cedar's coming. So cedar where it's exposed is getting replaced completely with hardback. But the rest, like the areas that's not affected by the elements, we're leaving a cedar. It was just going to be too costly, so we're leaving that. Painting everything, barbecues at the swimming pool, very nice arbor at the swimming pool, redoing the clubhouse and the leasing office. The clubhouse is huge. It's a decent size that they can use, but they're not using it for anything right now other than their own events. We are going to be renting them out for parties, redoing the entire pool area. We're doing interior rehab. So on our interior rehab, we make it look nice, but we have that one gotta have it element. And
what does that mean?
You walk in and you see a lot of apartments that look the same. Everybody goes gray. Everybody's got gray carpets. Everybody's got laminate. Looks like wood, but not everyone has the mosaic backsplash. You gotta have it. Those things are so pretty. So you have to have that, or everybody's got your standard chandeliers, and you've got this pretty crystal chandelier, or it's Waco, so you have your little lantern chandelier, that one thing that sets it apart from all the others.
Have you bought a bunch of stuff at the Magnolia?
No, we actually do have one rug that is by Magnolia Market, but we bought it here in Dallas.
What did the parking lot look like?
This last acquisition, we're just going to have a little bit of repair. Not bad. I think our budget for that parking lot is going to be about $30,000. Not bad. Compared to the last one was $100,000.
Yeah, the reason why I asked the question about the parking lots, it's such a critical piece when somebody drives onto your property. You can do a lot of exterior repairs by painting the property, putting, a new roof onto the property, and doing all kinds of exterior repairs to the property. But if you don't fix the parking lot or make it look all nice and pretty, it's like having wearing a black suit but having a brown pair of shoes. It just doesn't go. And for a lender, we want to make sure that it all flows, and it's kind of an indication that somebody's taking their eye off the ball if they don't have that parking lot either redone or putting a coat on it, making it all nice and restriped, making it all look nice.
Yeah, speaking of making it all look nice, we spent a lot of money on landscaping on the previous property as well as this one. Landscaping's underway. One of the things that we started doing recently on our rehabs is we just get rid of those bushes that it costs a lot of money to maintain. Each of those hedges trimming costs $2,500 for the whole property, so we just take them out.
So a lot of times we get stuck in the numbers, and I like to hear how you guys are having that gotta have it piece in your property. So that's great. A lot of times we forget that in order to, it's still a sales job from the beginning when they walk into the leasing office all the way to when they see a unit. So that's a great portion to mention. I guess on that piece, one thing that I did want to ask was upon, when you guys are looking at properties in Waco versus Dallas, can you give us maybe, let's say that same property, you dropped it into suburban Dallas. What do you think in terms of cap rate and dollar per unit you would have to pay versus it being in Waco?
Yeah. So I think on the very last acquisition, we're closer to 7 cap.
Okay.
And, we still have a lot of opportunity to raise rents, to make changes. Last property that we made an offer here in the Dallas market, we were outbid by $1 million. And that was about a 5.5 cap.
So similar vintage, sort of 1980s pitch roof,
exactly.
B property.
Yep.
Okay.
Exactly.
So
what you're telling me, you like the other markets, the secondary, tertiary markets, better than you like the Dallas?
Yeah, it's really good for us, but I think everybody else should avoid it until we've bought a few more properties in Waco. It just works for us.
So, again, as a deal sponsor, what's your day typically look like owning all these properties and being an asset manager?
So it kind of depends on where we are in the process. We're still fairly new into the process of the last acquisition, still in the rehab. So a lot of calls to contractors, talking to contractors, meeting with contractors, a lot of contractor design rehab related. I go to Floor and Decor. I'm like a kid in a candy store over there trying to decide on what we're going to do in terms of flooring and taking down walls and what we want to do. So a lot of time spent on house.com looking at ideas on what we're going to do from a design perspective, budgeting all the rehab and, reviewing all the proposals that we get. And some of it gets pretty confusing. On the pool, we have a lot of different options. Somebody will say, well, you shouldn't do cool coat. Some people will say, you should do cool coat because it's cheapest. And somebody else will say, put pavers. So making the decision over that. And then after things stabilize, it's mostly spending time on the property management software and looking at, keeping a pulse on the business, making sure that occupancy is still where it needs to be, delinquency doesn't go up, and keeping tabs on the management company, really.
What software program do you guys use?
We use Resman, and
how do you like that?
We like it a lot. The first one, I used something called Point 2 on the first property, and it was okay, but it was easier for people to make mistakes. So when I did my second property, I reviewed 6 or 7 because my background in IT, I was on the other side of it now and was able to, I have a spreadsheet of requirements for the software system. And coincidentally, our property management company had also just switched to Resman. So it's helpful for me to just use Resman for my property and switch over to just a different instance and still looking at Resman. And because I use the software to its fullest potential, I'm able to go back to them and say, well, I see that you guys do this way. Can you do it in the system instead? And they're usually free consulting.
So I know you as a real estate investor and deal sponsor, you're always constantly learning. Is there anything that maybe in the last year that you've changed your mind about? Like, I always like hearing, I thought it this way for 30 years and now all of a sudden in the last 1 or 2 years, something's changed in your mind. Anything that comes to mind?
Maybe not 30 years, but for sure, when I first started, sure. I wanted a property that was within an hour's driving distance. But after it's stabilized, it really doesn't matter. I'm hardly ever in Sherman myself anymore, even though I self-manage. I log in, I know what's going on to the property without having to physically be there. And then the other thing is pricing. When I started, $30,000 a door was kind of on the expensive side, and now you
60 a door.
Yeah.
Most of the time we ask for advice from first timers, but now maybe any advice from going from, let's say someone has 50 units already and really getting up to the 200 or 300 unit properties. What's the challenges there, and how maybe any advice for those people looking to move up into something bigger?
Go as big as you're comfortable with and you can afford to, because the bigger the property, the easier it is to manage. So I see more benefits than challenges going bigger.
Did you put hard money down when you guys were buying this property?
We did. On the last property, we did put hard money down, but...
How much?
On this one, it was $100,000.
Okay.
We had an opportunity, though, before the contract was finalized to send contractors to do some level of inspection, even though we didn't walk every single unit.
Yeah, get what's called an access agreement to the property. So we do like that.
Yeah.
So it gives you kind of a free look at the property before going hard with any money.
Yes, exactly.
Make sure you ask your broker about doing that if that's possible.
Okay. What if an investor wants to learn either more about you as a general partner, or just ask you if any more questions? What's the best way for them to reach you?
They can go to our website, www.prasiti.com, PRASITI.com.
One more time.
PRASITI.com. And there's information about my background and the deals that we've done, how they did, kind of our guiding principles, contact information's there, and an FAQ.
I love it. So
I wrote it myself.
Oh, good. Well, I thought Nitin would have written it for you. So Rupa is a great gal. We like her quite a bit, as you can imagine. She does a great job in putting these properties together. But now I'm going to go in a tangent. It has nothing to do with Rupa. It has nothing to do with her properties. James and I came across a transaction this morning that we've had some problems with, but I want to bring it to everybody's attention. It's really called, the thing I'm concerned about is specific performance. Specific performance. James, just give a little background of what happened.
So, a lot of times we make assumptions on, what the buyer is going to bring to the table and what the seller is going to bring to the table. So from the buyer's perspective, having the loan lined up on time, having their money ready to go at title to close these transactions. But on the other side of the table, a lot of times, the listing broker or the seller on their end, if they have a loan that is currently on the property, they need to deliver that property free and clear of that lien. And any other things that come up in title have to be cleared before we as the buyer can come in and purchase that property. So in one particular transaction we're working on right now, the seller put on a loan recently that locked them out for over 12 to 18 months before that lien could be released.
Which means they couldn't sell the property for another 18, 24 months really from now, because they put it on back, say,
beginning of the year.
Beginning of 2016. So when did we find out that that person had a lockout?
So, the seller will request a payoff from their current lender, typically 2-3 weeks before closing, and it takes that amount of time to figure out all the cost into it. But we got a letter today that stated you cannot pay off this loan, period.
So again, it's a purchase transaction. The seller went under contract with the buyer. The buyer, with the help of James, put the whole loan together with the belief that today was going to be the closing day. James arranged the financing as an underwriter loan officer for Old Capital. The money is at the title company. This day, about an hour and a half ago, 2 hours ago, we find out that the seller cannot sell the property because the loan that's on the property cannot be paid off until June or July of 2018.
So 2 years after.
So why that? That's a crushing blow for one thing, but it's a crushing blow for the buyer because they're out all their pursuit costs. They may have spent $20,000, $30,000, $40,000, $50,000 worth of getting attorneys, doing third parties, having the property reviewed, having attorneys draw up, all kinds of different things. But on the seller's part, they failed to disclose. The broker failed to disclose, or maybe just never asked the question: is there a prepayment penalty, or can this deal be paid off at the closing table? And the answer we're figuring out is no. It cannot be. So I'm pounding the table is that if you do get into a transaction, make sure the seller does not have a significant prepayment penalty, or if he does have a prepayment penalty, that he understands what that is, and so that we're not left in the lurch on this thing. Anything more to add to that, James?
So you can, as we say in underwriting world, trust but verify. So check into the existing liens and figure out when those are due, and if the seller understands what exactly he has to pay. Because some of these, so the prepayment, just to give you an example, this loan is under $3 million and it still has 9 years left on the loan term. And so the prepayment would be over $500,000. So that would eat up, majority of his profit if he had to prepay this loan.
It's crazy. But keep listening to the Old Capital podcast. So hopefully we can teach you that that's not going to happen to you, but it's happened to us or one of our buyers. What else should we be talking about, the white paper?
Sure. So if you're interested in learning more about apartment financing, please send an email to info@oldcapitallending.com, info@oldcapitallending.com. And if you like the podcast, please subscribe on iTunes and also leave us a 5-star rating.
Rupa, I cannot thank you enough. You're one of my favorites, as you know it. She's done a great job and owns 1,000+ units. So keep going, girl.
Always a pleasure being here, Paul. Thank you.
All right, James, thanks for hanging out with us. We appreciate it. We'll see you next time.
Thanks, Paul. Bye.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.